नमस्कार दोस्तों, I welcome you in this session. So, in the banking sector, we have discussed the evolution of banking system, the classification of different banks, different banking schemes, and now we are going to discuss two very important concepts, payment bank and the small finance banks. So we will discuss these two concepts in detail. So till now we have discussed all of this, and now we will be discussing differential and the other banks. So first of all, why payment bank and the small finance bank? So basically, if we see the overall structure of the banking system, we have commercial banks and we have cooperative banks. Inside the commercial banks, we have public and private bank, we have foreign banks, right? So these banks are operating at a very large scale. However, they are not technology driven platforms. First of all, this point. Secondly, they are not serving to the low income group in the adequate quantum. Financial inclusion is one of the important policy as far as the government is concerned. The financial inclusion basically means the financial services, out of which the banking services is a very important component. The banking services should reach out to each and every individual in the country. So with a commitment to ensure that banking services reach to each and every individual in the country, the government came up with the concept of payment bank and the small finance bank. So these banks are focused upon the financial inclusion. They are focusing upon those areas which got missed by the big banks. They are focusing on the low income household, small businessmen, unorganized sector, small and marginal farmers, etc. Right? So their focus area is upon the unserved and underserved sections of society. Secondly, they want to operate at small transaction level. So the vision of payment and small bank is that each and every individual should be able to transact even 5 rupees through the mobile phone. So we are in the world of UPI, we are in the world of Paytm, Google Pay, right? So the idea of payment bank and small finance bank may not look like that much attractive, but when we discuss this concept in detail, we will see that payment bank and small finance bank lay the foundation for ensuring that all those people who have missed the bus of banking services, they get the banking services, right? So now coming to the overall structure. So in the overall structure of the banking system, they are basically part of the commercial banking only. So inside the commercial bank, there is a category differential banks. So inside the differential bank, we already discussed regional rural bank. And there are three categories which we did not discuss till now. First is local area bank, then we have payment bank, and in the last we have small finance bank. So local area bank, payment bank and small finance bank, these three concepts we will discuss in detail in this session, right? So let us start with the payment bank and the small finance bank, right? So if we see the origin of the concept of payment bank and small finance bank, the origin belongs to Nachiket More committee. So this committee was constituted in the year 2013 by the Reserve Bank of India, and the mandate which was given to the committee was that those people who have not got the financial services, they should get the financial services. So the committee was supposed to lay down a mechanism so that all those people who are not under the banking system, they can get the benefit of the banking system, right? So differentiated banking by the Nachiket More committee introduced two new types of bank, payment bank and the small finance banks. Now, background of the payment bank. So if let us see the historical evolution of the payment bank. So if we see historical evolution, in September 2013, the committee was constituted on comprehensive financial services for small businessmen and low income households. So this committee is focusing upon financial services for small businessmen and low income household, right? And this committee was formed by RBI, Reserve Bank of India. This committee was headed by Nachiket More. This committee submitted its report in January 2014. So this is very quick. Normally committees take years and years. So any committee submitting its report within 3 months is a surprise. Anyways, one of its recommendations was the formation of new category of banks called the payment banks. The government took very fast action. In the Union Budget of 2014-15, the Union Budget of 2014-15 introduced and decided that RBI will create a framework. Framework means RBI will create a guideline system for licensing small banks and other differentiated banks, right? In November 2014, RBI came up with the guideline for the licensing, right? So as per Union Budget instructions, RBI came up with the guideline. Then in August 2015, RBI for the first time, it gave in principle approval to 11 entities to set up payment bank, which will be valid for a period of 18 months. So in August 2015, RBI granted in principle approval to the 11 entities that they can come and they can constitute themselves as the payment bank within the period of 18 months. So these are the different 11 entities, which includes Airtel Money, Fino, Indian Post Payment Banks, Vodafone M-Pesa, Vijay Shekhar Sharma, Paytm, right? So you can see all these entities, they got the in principle approval. But if we see as of now, only 4 banks are operating, right? So in November 2014, based on the recommendation of the Nachiket More committee, RBI invited the application. In February 2015, RBI released a list of 41 entities which had applied. So total 41 entities applied, and at this time only the India Post, the postal department of the government of India, it was given the first go ahead to carry out the payment bank operation through their vast payment network. In August 2015, RBI under the Banking Regulation Act 1949 gave 11 entities the licenses to operate as the payment bank. So which act? The act is Banking Regulation Act 1949. This can be a question in the prelims examination. Banking Regulation Act 1949 is the relevant act. In 2017, because of the different factors, only 7 out of these 11 they started the operation, with Airtel Payment Bank being the first. So Airtel Payment Bank was the first bank to start the operations. Then in 2019, only 4 payment banks out of the 7 have full-fledged business, with the rest of them they are either very limited or they are closing down their operations. So overall we can see only 4 payment banks are flourishing in a full-fledged manner as of now. Now, what is payment bank system? What is payment bank? So, payment bank. So, first of all, this is the bank. So, it will accept the deposits, right? Payment. So, it is focusing upon the payment and remittance services, right? The main idea behind the payment bank is that it will have restricted services, it will have focus upon selective services, and it will play at huge number of transactions. So it will accept the deposit, but this deposit will not be more than 1 lakh. So deposit of up to 1 lakh, and that too, these deposit cannot be term deposits. So these deposit cannot be the fixed deposit. Only the current account and the saving account deposit can be accepted, right? So this is the restriction on the deposit side. Now on the payment side, the restriction is that there can be no loan which can be provided by the payment bank. There can be no loan which can be provided by the payment bank. So loan is completely prohibited because the focus is upon the payment system. The government want to build the payment bank as the payment system, payment platform, rather than as the full-fledged bank. This is the idea. Therefore, there is no lending. So these are the new stripped down types of bank which are expected to reach their customers mainly through mobile phones, right? This is very important. They want to reach through mobile phones rather than traditional bank branches. So they will not be having the traditional bank branches. They will get the license, they will have their application, they will have their website, people will download the application, for example the Paytm, and people will pay the money, right? They are allowed to undertake only restricted banking functions that are the Banking Regulation Act of 1949 allows. So the Banking Regulation Act 1949, it allows only certain restricted banking functions for the payment banks, right? RBI in its guidelines says the objective. Now what is the objective of setting up of the payment bank? The objective is to further financial inclusion. This is very crucial, to further the financial inclusion by providing, number 1, small saving accounts. Small saving account. So saving account up to 1 lakh rupees, right? When I say small, that means up to 1 lakh rupees. Payment and remittance services. To whom? To, this is very crucial, please read this very carefully. To migrant labor workforce, low income households, small businesses, and other unorganized sector entities and the other users. right? So to the migrant labor workforce, the people who are migrating from one state to another state, low income household, for example, rickshaw pullers, the daily manual laborers, small businessmen, and other unorganized sector entities and the other users. So now let us see the basic fundamentals: registration, licensing, and the other regulations. So what are these regulations? Number one, the payment bank will be registered as the public limited company under the Companies Act 2013. So payment bank is a company, just like a commercial bank, it is a company only, right? Secondly, they will be getting the license under section 22 of the Banking Regulation Act 1949. So regulation will be done under the Banking Regulation Act of 1949. Third, restrict its activities mainly to accept the demand. So activities will be restricted. Restricted to what? Restricted to accept the demand deposits and the provision of payment and remittance services, right? So only demand deposit will be accepted, not the term deposits. So term deposits will not be accepted. Term deposits will not be accepted. Only demand deposit will be accepted. And provision of payment and remittance services. Number 4, should use the word payment bank in its name. So as a differentiator, they should use the word payment bank in their name so that people know that, okay, they are the payment bank. Now, what are the objective of setting up a payment bank? We just discussed in the previous slide, but let us revise again. Number 1, providing the small saving account up to rupees 1 lakh. Number 2, payment or remittance services to the migrant labor workforce, low income household, small businesses, other unorganized sector entities and other users. How? By enabling high volume, low value transactions. Please note it down. Please take care of this. High volume, so volume will be high, but value will be low. So the transaction of 10 rupees, 50 rupees, 100 rupees. But because a single user will be doing these transactions maybe tens of times in a single day, so the volume will be very, very huge. Because every person will be having the mobile application, so the user base will be very, very large, right? So enabling high volume, low value transactions in deposits and payments or remittance services in a secured technology driven environment, right? So this is also very crucial. Technology driven environment. This is also very, very crucial. Now, who may apply? So who can be the applicant? Who can establish the payment bank, or who can try to get the license? Number 1, existing non-bank prepaid payment instrument issuers. So can you give an example? Prepaid payment instrument issuer. So prepaid instrument issuer, for example, mobile, the mobile companies who are providing the prepaid SIMs, right? Under the Payment and Settlement System Act 2007. Number 2, individuals and professionals, they can also, so the people like you and me, we can also establish the payment bank. Number 3, NBFC, non-banking finance companies, NBFCs, corporate BCs. BCs means banking correspondents. So those corporates, those companies who are operating as the banking correspondents. Mobile telephone companies, for example, Airtel, Vodafone. Supermarket chains, for example, Future Group, Reliance Retail. Companies, real estate cooperatives that are owned and controlled, please be careful, by the residents. So it has to be owned and controlled by the resident, the people who are residing in India from the economic point of view, right? Number 4, public sector entities. So public sector entities, for example, India Post. For example, India Post, they are also authorized to apply, right? So these are the people who can apply. UPSC has already asked the question in 2016. So this payment bank system was highly in use in the year 2015. Therefore, it was quite natural to ask the question in the year 2016. Now, structure of the payment bank. What is the structure? So first of all, they can have the minimum capital of 100 crore rupees. So minimum paid up capital of 100 crore rupees will be required. So the people like you and me, firstly we have to arrange this 100 crore rupees, then only we can think of establishing the payment bank. Number 2, maintain the 75% of deposits in the government securities. So whatever deposit they are receiving, out of that 75% they will be investing in the government bond. But why? Why this restriction? The purpose is to ensure the security of funds. The purpose is to ensure that those funds which these banks are receiving from the public, those funds are safe and secure, so that the liquidity is maintained. Next, they should maintain 25% of the deposit in the other banks. So the other bank means other commercial, scheduled commercial banks, right? So they should maintain 25% of deposit in the other bank. The purpose is to ensure that operational funding, right? So operational and day-to-day funding requirement can be met from the balances in the other bank, right? So they will open the bank account in other bank, for example, State Bank of India, and they will withdraw the money as and when required. So this will ensure the smooth operation and the no default in the payment by the banks. Have at least 26% investment by the Indians. So at least 26% investment has to be done by the Indians. That means maximum 74% FDI is allowed. So this FDI is more than enough, right? So this FDI is more than enough. It can only accept CASA deposit. CASA basically represents current account and saving account, right? Current account and saving account, they represent only demand deposit. That means those deposits which are payable on demand. Those deposits which are payable on demand. So CASA represents current account, saving account, deposit. That means the term deposit or the long-term deposit, fixed deposit, they are not allowed in the payment banks because the main purpose is to give the payment. The main purpose is not to earn the income by depositing the money in the payment bank. The liability should not exceed 20 times of its net worth. They should have 25% of the branches in the unbanked areas, right? So this will ensure that they also serve to the unbanked areas. This will ensure that they spread to the unbanked areas and they are not restricted to the profit making urban areas, right? Next, features of the payment bank. So who can promote? We have already discussed prepaid card issuers, telecom companies, NBFC, business correspondents, supermarket chains, corporate realty sector cooperatives, and the PSUs, and they should be owned and controlled by the residents. So that is also very crucial. Now the question arises. Now you will say, sir, they cannot lend, they cannot give the loan, right? At the same time, they will operate at a very low value transaction level. So how will payment bank will earn? How will they be able to do the business in the market, in the competitive market? So I have the justification. First of all, if you see, at present, the biggest problem in the banking system is the default by the loan holders. Are you getting? So the biggest problem today is the defaults which are being made by the loan holders. The NPA, non-performing asset. Now coming to the bank, payment bank, because there is no lending, so there is no default, so there is no losses on account of the default. This is the first thing. Secondly, this payment bank, they will be playing at a very huge scale. As I told you, the single individual may have to use the application of Paytm, Airtel Bank, etc. maybe 50 times a day. And in a family, if there are 5 members, then all of them can have maybe more than 100 transactions in a day. They are paying for the milk vendor, they are paying for the rickshaw puller, they are paying for the grocery store, they are paying for the medicine bill. So maybe 5 people together, they will do hundreds of transactions when they are in the market in a day. So for every transaction, if they charge just 1%, they will earn huge amount of money, right? So first, they will charge 1% to 2% on the normal cash transfer. There is no risk of NPA, and they will play on volume on volume by attaching the million of customers, right? The RBI allows these banks to invest 75% in government security and 25% in bank. They also earn the income from here also. So the government security are the safest form of investment. So the payment bank, they get the huge amount of income by investing into the government security. Now, what can they do and what they cannot do? Very important. Number one, what they can do? They can accept the deposit of up to rupees 1 lakh, but this deposit will be demand deposit. This deposit will be demand deposit. Number two, they can offer internet banking. So as I told, they are technology driven platforms. They can sell the mutual funds, insurance products and pension products. But for that, they have to get the approval from the Reserve Bank of India. So after getting the approval from the Reserve Bank of India, they can sell the mutual fund, insurance and the pension funds. Through these products, they can actually earn the profits. Then they can offer the bill payment services for the customer. So we have the electricity bill, gas bill, water bill and many other bills. For example, credit card bill. So all these kind of bills can be paid from the payment bank. Next, they can have the business correspondents, right? Now, what they can't do, this is very crucial. First, they cannot offer the credit card. They cannot offer the credit card. However, they can offer the debit card and they can offer the ATM services. The debit card and the ATM services are allowed, but the credit card is not possible. Number two, they can extend the loan. They can extend the loan. Sorry, they cannot extend the loan. They cannot extend the loan. Number three, they cannot handle the cross-border remittances. So the remittances across borders. The remittances across borders cannot be handled. Next, they cannot accept the NRI deposit. They can accept the deposit only from within the country. They cannot accept the deposit from the outside country. So this picture represents the smart payment bank model, right? So you can see the payment bank will be offering the mobile or web application, ATM, POS and other enabling infrastructure. So all these things will be there, and through this the transfer and remittances can be there, payment for the e-commerce portal can be there, lot of recharge payment for the mobile, DTH, electricity, data card, landline, gas, insurance, gold loan, metro, water, hotel, bus, all these payment can be done. So this is how the payment bank want to play on the volume of transactions. Now, there are some restrictions on the payment banks. Let us see what are those restrictions. So the other restrictions include they have to invest minimum 75% of its demand deposit balances in the government securities or treasury bills with the maturity of up to 1 year for the maintenance of SLR, right? So as I already told you that up to 75%, so minimum 75% of their fund they have to deposit in the government security. Number 2, they hold maximum 25% in the current and time of fixed deposit with other scheduled commercial banks for operational purpose and liquidity management, right? So 75% in the government security and 25% in the other banks. Friends, some of you might be thinking that why I am repeating the same thing again and again. I discussed this point in the previous slide, but why again I am repeating this point here? My answer is that I want that all the important points you should cover multiple times. So that will ensure that you do not forget the important point in the examination hall, right? So if I am repeating something, that does not mean that your time is being wasted. The only purpose is that you get to listen to the concept again and again so that your concept becomes strong, right? Then it shall have paid up equity capital of 100 crore rupees. This is something unique. It shall maintain minimum capital adequacy ratio of 15%. So capital adequacy ratio of 15% of its risk weighted asset will be maintained, right? So in case of public sector bank, this capital adequacy ratio is 12%, but in case of payment bank this is 15%. That means the government wants that these banks should be more robust. They should be more robust. Next, tier 1 capital should be at least 7.5% of RWA and tier 2 capital should be limited to maximum 100% of the total tier 1. That means tier 1 should be minimum 7.5% of the risk weighted asset, and the tier 2 it should be maximum 100% of tier 1. So if tier 1 is 7.5%, the tier 2 cannot exceed 7.5%. It cannot exceed 7.5%. Then it should have a leverage ratio of not less than 3%. This is not important for you. This is a very technical point. I will not discuss. Then promoters contribution. Promoters means those people who have actually contributed to the initial capital. So the promoter should be holding at least 40% of its paid up equity capital for the first 5 years from the commencement of its business, right? So they should be holding minimum 40% of their shares for the first 5 years. Mandatory listing if the net worth reaches 500 crore. So if the net worth of the company reaches 500 crore, if the company becomes big, then within 3 years the 500 the company should be listed. The company should be listed in the stock exchange. Now, what will be the benefit to the society? What will be the benefit to the society? Number 1, service charge will come down because they will infuse a lot of competition. the big banks, they will face the heat of competition. So the service charge for the transaction will come down. Then there is no requirement of minimum balance. So because there is no requirement of minimum balance, so the low income household, they will not be worried that if they do not maintain the minimum balance, then their amount will be deducted. RBI rate cut benefit. So if RBI cuts the interest rate, it will benefit the payment banks and the society also. Payment bank may take handling cash a lot easier because they will be technology driven and they will give the access to the banking services for everyone. So the requirement for cash handling will be minimized. Now, what are the challenges that they face? The first major challenge is that this Nachiket More committee, it was introduced in 2013 and it gave its recommendation in July 2014, and in August 14 the Pradhan Mantri Jan Dhan Yojana was launched. This Pradhan Mantri Jan Dhan Yojana is actually also focusing upon the financial inclusion, and this also provides the condition of no minimum balance, right? So this will actually fulfill the purpose of the payment bank. So under this scheme, everyone in the nation was to get a basic bank account with an ATM card, life and accident insurance. Thus, the basic purpose of payment bank was fulfilled as a result of Pradhan Mantri Jan Dhan Yojana. As a result, the scope of expansion of business for this bank has become limited from the starting itself, and that is the reason why, despite 11 entities getting the license, only 4 are able to operate, because on the parallel the government has introduced Pradhan Mantri Jan Dhan Yojana, which is actually providing no balance account. Then acceptance by the masses. So friends, commercial banks, the public sector banks, they have the mass following, right? The government is backing commercial banks because government is the major shareholder in the public sector banks. But in case of payment bank, the government do not have the guarantee. The government do not provide the ownership. Because of that, the confidence of the masses in the payment bank cannot be built. So the big commercial government banks, SBI, PNB, UBI, etc., are much trusted by the society today. These new payment banks will find it difficult to earn the level of trust that the government sector banks command today. Competition from the existing bank, that is also one of the big problem. So existing bank, they have huge banking infrastructure. So they will give the competition to the payment bank, right? So the first problem was the Pradhan Mantri Jan Dhan Yojana. Secondly, the trust, and third, the competition from the existing banks. Now, how the payment banks can ensure that their future prospects are good, right? First, they should introduce customer-friendly and tailor-made interfaces so that the public perception about them is enhanced. They can divert the attention of the customer from the traditional banking to the payment banking. They should tie up with the entities with the local feel. They should provide the multi-product and multi-service business correspondent model, and they should be working with the sharing of government business of DBT on fair sharing business model, and they should work on the cyber security regime. India Post Payment Bank, as I discussed, that this was the first bank which was given the go ahead. So this is becoming one of the very biggest banking platform. So the postman, they will become the banker for the millions, especially the underbanked Indians. 3 lakh plus postmen and Gramin Dak Sevak will serve, and 1.55 lakh post offices, they will be linked with the Indian Post Payment Bank. Now, the previous year question. So take 30 seconds and read this question and solve this question in another 30 seconds. So total 1 minute I am giving to you. solve this question and then we will discuss further. So let us read the question. The establishment of payment bank is being allowed in India to promote financial inclusion. Which of the following statements is or are correct in this context? Statement number 1, mobile telephone companies and supermarket chains. Mobile telephone companies and supermarket chains that are owned and controlled by the residents are eligible to be promoters of payment banks. So this statement is perfectly right. We already discussed the basic condition of how and who can apply. Number 2, payment bank can issue both credit card and debit card. This credit card is impossible because they cannot give the loan, and credit card is a kind of lending. So this statement number 2 is wrong. Statement number 3, payment banks cannot undertake lending activities. This is true. So answer is option B, statement 1 and 3. So answer is option B, statement 1 and 3. Now we will discuss a small finance bank. Right? Now, how the payment bank and the small finance bank are different. Right? So this is how we will start the discussion so that you can get the clarity. So we have the payment banks and small finance bank, right? This payment bank, they can accept only demand deposits. A small finance bank, they can accept all types of deposits. Right? So they can accept only demand deposit, they can accept all types of deposit. This is the one difference. Secondly, they cannot give the loan. So they cannot lend. They can give the loan. This is one of the very big difference between the two, right? So payment bank are focusing upon the payment ecosystem. The small finance banks are actually focusing upon the small income groups. Small income groups in a specified area, right? So their area of operation is comparatively limited. They are located in a very a limited region, very specific region. For example, they operate in the West UP, East UP, maybe an area having a group of 20 districts. So their operation is the area of operation is comparatively limited. They can give the loan, but this loan amount will be small. they will be catering to the small income groups. Their focus will be upon the small income groups, right? So you can see these are the two major differences, that it can accept only demand deposit, it can accept all kind of deposit. They cannot lend and they can give the loan, and they will operate at the restricted level. As of now, we can see that there are 10 entities, 10 companies who got the licenses for the small finance bank from the RBI, right? So out of this, Ujjivan, it is operating, and many more, for example Utkarsh, they are operating very well as of now. Now the basic about the small finance bank: registration, licensing and the regulations. Point number 1, they should be registered as a public limited company under the Companies Act 2013. So this is the condition very much similar to the payment bank. Number 2, they should be licensed under section 22 of the Banking Regulation Act 1949. This is also very clear. Number 3, they should be given scheduled bank status once they commence their operation. This is very, different. So they should be given the scheduled bank status. This is very crucial. This is very unique. This is different from the payment bank. They should use the word small finance bank in its name, so that people can identify that they are the small finance bank. They are not the normal banks. Objective of setting up a small finance bank: number 1, provision of saving vehicle. Very, very important. Saving vehicle to unserved and underserved section of the population. So the unserved and underserved section of the population, they will get a platform, they will get a place where they can make the saving. Supply of credit to small businesses, small business units, small and marginal farmers, micro and small industries and other unorganized sector entities through high technology, low cost operations, right? So supply of credit to small business units, small and marginal farmers, micro and small industries and other unorganized sector entities through high technology, low cost operations. Who can apply? Who can apply? Number 1, resident individuals. Please be careful. Resident, not anyone. Resident individuals and professionals with 10 years of experience in the banking and finance. So the people should be having the 10 years experience. Companies and societies owned and controlled by residents. So everywhere you will find resident. Existing NBFCs, microfinance institutions and local area banks. So NBFC means non-banking finance companies. For example, IL&FS, right? Microfinance institutions, those institutions who are providing very small amount of finances or loans. Local area bank that are owned and controlled by the resident who can opt for conversion into the small finance bank. So these NBFC, NFI, MFI and local area bank, they can be converted into the small finance banks. Who may apply? Who may not apply? This is also very crucial. Large public sector entities and industrial and business houses, right? So they cannot apply. They cannot apply. Activities which can be undertaken by the small finance banks. Number 1, acceptance of deposit, and they can accept all kinds of deposit. They can accept all kinds of deposit. Next, lending activities. So they can give the loan as compared to the payment bank. They can give the loan. Can become a category 2 authorized dealer in the foreign exchange business. So they can also deal in the foreign exchange transactions. Internet banking, functioning as the business correspondent of other banks. What is the meaning of business correspondent? Business correspondent is any agency which goes door to door to the customer's house and gives them the access to the deposit and the withdrawal services. So they will carry a small device. The person will carry the small device, go to the customer's doorstep and will ask, do you want to deposit some money into the bank or do you want to withdraw some money? And the transaction will be happening at the doorstep of the customer, right? So that is how this business correspondent operate. Non-risk sharing simple, non-risk sharing simple financial services activities such as distribution of mutual fund units, insurance products, pension products, etc. with the prior approval of the RBI and after complying with the requirements of the sector regulator, etc. So prior approval of the RBI will be required before it can enter into mutual fund unit, insurance product and pension product. Utility bill payment, this can also be allowed. So there are large number of activities which can be done by the small finance banks. Activities which cannot be undertaken, this is also very crucial. Cannot set up subsidiaries to undertake non-banking financial services activity. So this is a kind of summary. You can see key features of the small finance bank. Eligibility: professionals with 10 years of experience in the banking, finance companies, MFIs and local area banks. Promoter must have at least 5-year track record also. This is also one requirement. Capital: minimum paid up capital is 100 crore. The RBI has proposed that it will be increased to 200 crores. Scope of activity: provide basic banking to low income group, small businessmen, farmers and unorganized sector. So it will be focusing upon the low income group, small businessmen, farmers and the unorganized sector. Promoters contribution: promoters initial contribution should be 40% and should be lowered to 26% in the 12 years. Foreign shareholding as per FDI norms for the private bank. So whatever FDI norms are there for the private bank, those norms will be applicable for the small finance bank. Other conditions: follow all prudential norms. At least 50% of the loan portfolio to be given for advances up to rupees 25 lakh, right? That means all the loans which will be given, out of those loans, around 50% of the loan they should be less of the value of less than rupees 25 lakh. The purpose is that the loan should be given to the small income group people, right? So the loan value should be less than 25 lakh rupees for more than 50% of the loan given by this. Large NBFCs cannot apply for being the small finance bank. They are required to maintain CRR and SLR because they are into the lending activity. Therefore, they are supposed to keep the SLR and CRR. However, payment bank are not supposed to have the SLR and CRR. They are required to extend 75% of its adjusted net bank credit to the sectors eligible for classification as priority sector lending. So we have already discussed the priority sector lending norms. So small finance banks, they are required to extend 75% of its adjusted net bank credit to the sectors eligible for classification as the priority sector lending by the RBI. There are some other restrictions: paid up equity capital of 100 crore, capital adequacy ratio of 15%, 7.5% tier 1, maximum 100% of tier 1 should be the tier 2, leverage ratio of not less than 3%, 75% in the priority sector lending, at least 50% of the loan portfolio should be consisting of the loans and advances up to rupees 25 lakh. Promoters contribution: promoter should hold at least 40% of its paid up equity capital for the first 5 years from the commencement of its business, should be brought down to 30% within a period of 10 years and to 26% within a period of 12 years. Mandatory listing if the net worth exceeds 500 crore rupees within the 3 years of reaching that net worth, the small finance bank will be listing down, right? So friends, all these are not conceptual, these are very informative. Still you should go through once because there can be question on any of these aspects. We have already seen in 2016 there was a question from that who can make the payment bank. So important features: they can accept any deposit, they can lend the money. For the initial 3 years, they require the prior approval of the RBI for branch expansion. To give the feel of local bank, their area of operation will be restricted. Maximum loan size to a single person cannot exceed 10% of the total capital funds and cannot exceed 15% in case of a group. So to ensure that their loan is not being given to a particular person or particular group of people, it will be ensured that maximum loan size to a single person cannot exceed 10% of the total capital fund and cannot exceed 15% in the case of a group. Now UPSC question. Please see this question, take 30 seconds and then we will see. Let us read the question. What is the purpose of setting up of a small finance bank? The question is asking the purpose. Statement 1, to supply credit to small business units. This is right. To supply credit to small and marginal farmers. This is also right. To encourage young entrepreneurs to set up business, particularly in the rural areas. This has not been given anywhere. So answer is option A, statement 1 and 2 only. So answer is option A, statement 1 and 2 only. Now let us see a little bit about the differences and the similarities between the small finance bank and the payment bank. So payment bank, their focus is upon the financial inclusion. Small finance bank, their focus is upon the providing total banking services to the small and medium enterprises. Payment bank, they can accept the deposit up to rupees 1 lakh. A small finance bank, they can accept the deposit of any amount. So there is no limit on the amount. They cannot lend to anyone. They cannot lend. They cannot give the loan. They can give the loan, but largely to the SME and the farmers only. They can issue the ATM and the debit card, but they cannot issue the credit card. They can issue ATM, debit card and the credit card. They cannot give the loans. They have to ensure that 50% of the loan which they are giving is in the form of advance of up to 25 lakh rupees. They can provide the remittance services. They can also provide the remittance services. They can distribute the financial services like mutual fund, and they can also do this. So this is the difference and some of the similarities also. What are the similarities? First, they can provide the deposit services. The focus should be on the unbanked population. This helps in motivating the people to save and keep the fund for the future. They provide the interest on the saving held with these banks. So interest is provided. They provide the payment and the remittance services. These are the similarities. If we compare the commercial bank, for example, SBI, small finance bank and payment bank, all of them, they accept the deposit, right? All of them, they are the payment platform also. But lending of loan is not allowed to the payment bank. Commercial bank and small finance bank, they can give the loans. This is a chart of comparison. We have discussed enough. Still, you can take 1 minute and read this carefully. I will increase the size so that you can read it carefully. So take 1 minute and read the entire chart carefully. So we have discussed it enough. Now coming to the local area banks. So in the starting I told you, in the category of differential banks, we have regional rural banks which we discussed earlier, payment bank, small finance bank, and now local area bank. So they are the private banks. They are the small size private bank which focus on providing low cost structures to provide efficient and competitive financial intermediation services in the limited area of operation, normally up to 3 districts continuously, right? So friends, as of now they have been given the opportunity to convert themselves into the small finance bank. So when we read this thing, you will find that their features are very much similar to the small finance bank, right? So they have now been given the option to convert into the small finance bank. So local area bank, name itself says local area. So they are operating in the local area of 3 districts. Local area bank were set up to enable the mobilization of rural savings by the local institutions and at the same time to make them available for investment in the local areas. So they will mobilize the savings from the local people and they will allow that saving to be used as the investment into the market. RBI issued guidelines in the 1996. So these they are operating since 1996. So it's been over 24 years as of now. Local area bank were required to have minimum capital of 5 crore rupees. So in case of a small finance bank, 100 crore rupees. Here this is just 5 crore rupees. The promoters of the bank may comprise of private individuals, corporate entities, trust and societies with a minimum capital contribution of rupees 2 crore. So the promoter should be giving at least 2 crore, that is 40% of the total capital in the starting. The area of operation of local area bank is limited to a maximum of 3 geographical contiguous districts and are allowed to open branches only in its area of operation. So they can open the branches only and only in its area of operation. Local area banks are also required to observe priority sector lending target of 40%. This is also very important that they have to maintain the target of 40% loan to the priority sector as specified by the RBI. Around 5 local area banks were licensed by 2002 under the section 22 of the Banking Regulation Act 1949, and as of now 3 local area banks are functioning. We do not need to remember the name. In 2014, RBI has permitted local area bank to be converted into small finance banks subject to them meeting the prescribed eligibility criteria, that is the condition of 100 crore etc. Another category which is not part of any of these is land development bank. So the name itself says land, so they are focusing upon the development of the land, right? So they are meant to provide long-term agriculture needs of agriculturists for a period ranging from 5 to 25 years for the following purposes. So what are the purposes? Number 1, to make improvement in the land. Number 2, to repay old loans. Number 3, to free the mortgage land, and number 4, to buy the land. So all these activities which are concerned with the land, they are allowed, they are contributed by the Land Development Bank. With this session is complete. Thank you very much. God bless you.